Hello friends, welcome to this opening lecture. Friends, all credit for development of Bollinger Band goes to John Bollinger. He developed Bollinger Bands in the mid-1980s. Initially these were called trading bands, but later on John Bollinger named these bands as Bollinger Bands. As we have learned in the introduction lecture, Bollinger Bands are used to measure market volatility and even for identifying overbought and oversold conditions. Basically, this little tool tells us whether the market is quiet, that is low volatile, or whether the market is loud, that is highly volatile. So when you insert Bollinger Bands into your charting platform, it looks like this yellow envelope of bands engulfing price, with price piercing these bands here and there. Please note, when market is quiet, the bands contract, as you can see here in this hourly chart of Asian Paints. In the regions A and B, you can see market is quiet or less volatile, so Bollinger Bands also shrinks or contracts. And when the market is loud, the bands expand, as you can see in the regions C and D. In both these regions, stock expansion is there, and so these regions are best suited for trading purposes. Now the structure of Bollinger Bands is pretty simple. As you can see, it contains this middle line, that is this blue dotted line, and then two yellow color bands engulfing the price, that is candlesticks. Friends, this middle band is actually a 20 period moving average. At this level, I hope you know what a moving average is. But if you are new, then please note moving average is simply a line plotted using average of last 20-day closing price in the case of daily chart. Then next we have this upper band, which spreads above the mid moving average by a volatility measure known as standard deviation. By default, the band is set at 2 standard deviations, or we can also calculate using this formula, that is 20-day simple moving average plus 20-day standard deviation of price multiplied by 2. Now at this point, I am sure you must be questioning what this standard deviation is and why it's used here. Friends, I won't get into the mathematical formula of standard deviation at this point and how it's calculated, because it's not that useful for your trading. But I will explain what standard deviation is in simple layman language. So standard deviation is basically a statistical measure of market volatility only. This measures how widely prices are dispersed from the average price. Or you can also say this in another way, that standard deviation tells how spread out are the asset prices around the 20 period moving average. So if prices trade in a narrow or confined range like this, then the standard deviation will return a low value that indicates low volatility. On the other hand, if prices swing way up and down, then standard deviation returns are very high, which indicates high volatility. And that's why you most often see a volatile stock has a high standard deviation, while the standard deviation of a stable blue chip stock is rather low. And friends, finally we have this lower band, which is middle band less same volatility measure as we have for upper band. Or we can also calculate this band using the formula 20-day simple moving average minus 20-day standard deviation of price multiplied by 2. So I will summarize again that Bollinger Bands represents the volatility of the stock as it increases or decreases. The bands are, as you have seen, are placed above and below the moving average line of the asset class. And we have also seen the wider the gap between the bands, higher is the degree of volatility. On the other hand, as the width within the band decreases, lower is the degree of volatility in that particular stock or currency pair. With this, I hope the structure of Bollinger Bands is clear to you. In next lecture, we will discuss a very important point which must be in your mind, that why we use 2 standard deviation for calculation of bands and why not 1 or 3 standard deviation. See you in the next lecture.